It's a brand new week. Good morning and welcome to Business Morning. I'm Chimize Obi Iwag. We kick off the show with updates on the global oil market as prices rose in early morning trade, recouping some losses after Friday's plunge of about $10 a barrel as investors looked for bargains but remained cautious with a focus on the Omicron coronavirus variant and Iran nuclear deal negotiations. Brent crude futures climbed $3.05 to $75.77 a barrel after falling $9.50 on Friday. U.S. West Texas Intermediate crude was up $3.27 at $71.42 a barrel, having tumbled $10.24 in the previous session. Oil prices crashed together with other financial markets on Friday by more than 10%, their largest one-day drop since April 2020, as the new variant spooked investors and added to concerns that a supply surplus could swell in the first quarter. The Omicron coronavirus variant spread around the world on Sunday, with new cases found in the Netherlands, Denmark, and Australia, even as more countries imposed travel restrictions. The World Health Organization said it was not yet clear whether Omicron, first detected in southern Africa, is more transmissible or dangerous than other variants. The Organization of the Petroleum Exporting Countries and its allies have postponed technical meetings to later this week, giving themselves more time to assess the impact of the Omicron variant on oil demand and prices. OPEC Plus will now meet on Thursday instead of Tuesday, when a policy decision will likely be announced on whether to adjust its plans to increase output by 400,000 barrels per day in January and beyond. And over the weekend, the Central Bank Governor, Mr. Godwin Emefiele, said Nigeria's growth has returned to the level it was before it got hit by the global COVID-19 pandemic. Mr. Emefiele, who made this known at the 56th annual dinner of the Chartered Institute of Bankers held in Lagos over the weekend, also highlighted some of the efforts made by the Central Bank and the federal government towards the country's economic recovery. Let's take a listen.
Following the impact of the various accommodative policy measures, our economy made a swift exit from the recession. Unlike the 5 quarters it took to exit the previous recession, the economy rebounded after just 2 quarters of contractions, underpinning the resilience of the economy amidst greater policy support. I'm delighted to note that growth has returned to pre-COVID levels due to the accommodative policy support provided by the CBN and our government. Notwithstanding these positive indicators, our economic growth remains fragile, as our unemployment and inflation rate remains at levels that are not very supportive of growth. Second, continued implementation of our intervention efforts would need to be undertaken to sustain the recovery efforts and stimulate further growth of the economy. Third, given a population growth rate of about 2.7% annually, it is important that we continue to deploy measures that will enable our economy to attain annual growth rate of above 5%. Now, we also do intend to mobilize international capital. A key challenge to supporting the growth in key sectors of our economy is access to large pools of cheap investment capital. Today, over $100 trillion is held by institutional investors in OECD countries, most of it invested in low-yielding assets relative to high-yielding opportunities in Nigeria. And working to tap into this pool of funds will require the setup of an investment framework that offers comfort and security to investors seeking to invest in critical sectors of our economy. As a result, the CBN is working to set up the International Financial Center at Eko Atlantic City in Lagos that will serve as a hub for attracting domestic and external capital, which is needed to strengthen our post-COVID economy. Our International Financial Center, when fully operational in the second quarter of 2022, will help to position Nigeria as a key destination for investment in Africa.
That was Godwin Emefiele, Governor of Central Bank. In the meantime, at that event on Friday, the governor maintained that the banking sector has remained robust and sound, despite the effects of the pandemic. And this is due to prompt responses by the central bank in order to prevent an economic crisis from spilling over into a financial crisis. He, however, says there was some fragilities in the system, but they constituted limited risks. According to him, prudential indicators such as non-performing loans stood at 5.4% in November 2021, while the capital adequacy ratio remained above 15%. Meanwhile, a research and investment bank, AfriInvest West Africa, in its 2021 banking sector report titled Resilience Amidst Endemic and Pandemic Constraints, noted that the banking sector faces a continuous period of uncertainty, and the resilience of the sector will depend on players' response to new developments. To shed more light on this, I'm being joined by the Deputy Group MD, AfriInvest West Africa, Victor Ndokuba. Thank you very much, Victor, for joining us on the program.
Thank you, Chimizi. Good morning.
Good morning. So every year, AfriInvest reports on the performance of the Nigerian bank, and this year your report seemed to corroborate central bank's stance that the banking sector remains resilient amidst the pandemic. So what for you were the key factors that shaped the banking sector landscape in this year?
Thank you again for having me, and it's my pleasure to be here. This year's AfriInvest annual banking sector report x-rayed the performance of banks, vis-a-vis the context of the broader economy and the challenges that continue to ensue, particularly from the impact of COVID and what it did in terms of shutting down the economy. Prior to COVID, of course, we still had, lingering endemic issues with the economy, specifically around inflation, unemployment, and the persistent issues with the FX supply and liquidity and all of that. But I think, by and large, when we look at the performance of banks coming into 2021, we see what we term to be resilience, and what does that mean? Essentially, it's deriving from the performance of banks, despite myriad challenges, that ensue or that they continue to face. On the economic front, you have issues with growth. Low levels of growth. We had a recession that obviously didn't last too long, thankfully, 2 quarters, and we rebounded fairly strongly. And thankfully, banks were able to very quickly adjust their loan books as well, restructuring in some cases, tenors, and in some cases allowing certain forbearances, which allowed businesses to sort of get back on their feet. Overall, when we then, put that side by side, the fact that, COVID continues to be a clear and present danger. Only just last weekend, we've heard about the emergence of Omicron, a new variant that, while still being studied, suggests that it's a bit more infectious and perhaps a bit more, severe in its impact. But overall, we think the banks have performed fairly well when we just put it side by side, the challenges that continue to bedevil the economy.
All right. Now, taking it from, where we're coming from, 2020, I remember one of the measures taken perhaps to improve the flow of credit to households and businesses during this pandemic. We saw the MPR being reduced from 13.5% to 11.5%. And of course, there was an increase on the CRR from 22.5 to 27.5. And over time, we've seen banks, complain about the frequent CRR debit. That's one regulatory issue that seemed to have bedeviled the bank during the period. And of course, there's also this 65% LDR.
Loan to deposits.
Yes. So how much impact did this policy, from the central bank, how much impact did it have on the bank's ability to actually give out credit, which is one of the reasons that the central bank actually came up with that policy?
So thanks. You're right. The question, frames it as something that has, evoked a bit of complaint from within the banking quarters, and rightfully so. But be that as it may, when we look at the overall performance and we look at the banks, using the I think, a list of 15 banks which are listed as a proxy for the sector as a whole. We find that loans grew in double digits, I think, almost 15%, thereabouts. And on the back of that, however, while income from loans slightly declined compared to 2020, coming in at about 1.1 trillion in total, we find that the challenge with that, obviously, is the fact that the extension of credit, whilst growing up in absolute terms, did not quite translate into increased income for a number of reasons. Already, we talked about the fact that coming from 2020, there was, lingering issues with companies who, having to have shut down for several months at a time, were struggling to essentially grow their performance in terms of reported revenues, in terms of operating stats, income levels, EBITDA and things like that. So the ability to service loans was challenged, and so banks, proactively restructure some of those loans. But we also found that by virtue of the amount of liquidity in the system, the overall yield in the environment also declined. So what it meant was the pricing for loans also declined comparatively to the earlier years. So while loans in total, in terms of the volume, was up, the income from those segments were slightly down. Now, how the bank offset for this? We also recognize that because of the impact of COVID and what it did to restriction of movement, lockdowns and, social distancing and all of the other isolation measures, there was a widespread increased levels of adoption of digital channels and alternative means for banking. So we saw a significant rise for virtually all banks in terms of adoption of digital channels, using things like mobile apps, USSD banking and ATMs, or even in many cases, POS banking. Now, what has that done? It meant that the flip side is that on the sort of fee and commission income side, we've seen some upside for some banks. Now, not all banks enjoy that benefit anyway, because while the volumes overall were up in many cases 30%, 50%, in some cases 25%, income levels also did drop because, again, the competitive landscape meant that they had to be price sensitive and adjust for some of that. But overall, when we then put that side by side, the sort of investment income that comes from yield, we find that on balance, it's fair. What the CBN sought to achieve with some of those policies, especially the loan-to-deposit ratio at 65%, was to force the hand of banks, towards lending as against just playing on Treasury, which is playing around with investment income. Now, how beneficial has that been? In many cases, you find that whilst there's a desire to lend, the challenge on the flip side is that corporates are also not very keen to extend themselves in a period when there's a lot of uncertainty around the market. As you may obviously be aware, inflation has been quite high. Thankfully, it's been declining for, it's going on 9 months now consecutively, but it's still very high, double digits, coming down from nearly 18% to right now just under 16%. But what that means in everyday terms is that the average person is struggling to purchase services and goods, especially things like food, staples, because prices have gone up so much so that people are spending a lot more of their purse on some basics like feeding, and what that means is that there's not a lot of money available on other things, So disposable income has come under a lot of challenge because of inflation. The exchange rate itself also continues to create a feed-through effect, in some cases, again, for certain elements of imported items, and therefore imported inflation as well comes under pressure. So when you put all of that together, you see that while banks want to lend, there is not as much appetite from the businesses to take on credit because they're not quite sure that whatever they take the credit to fund in terms of activities or manufacturing would feed through
with
the market.
this CRR now still remaining at 27.5%, and we have the LDR at 65%, what does that mean for the banking sector going forward? And from AfriInvest's perspective, if the central bank should actually act on this, what is more appropriate?
So ultimately, the central bank, retains the exclusive preserve to manage monetary policy, and those two ratios fit squarely within its remit. The cash reserve ratio essentially is a ratio that the CBN uses to determine how much of each single deposit that comes into the bank is retained by the banks in the CBN's vaults. So at 27.5%, it means that for every 100 naira that comes through in deposits, 27.5 is held in an account to CBN that earns zero or next to zero. So in effect, it's called sterilization. So what it means is that the banks are therefore required to earn income on a fraction, just nearly 70, just under 70%, about 63% of whatever income, of whatever deposits they've taken. So that puts them first under pressure. Of course, there is the loan to deposits, which then sort of speaks again to the total liability or ability of the banks to mobilize deposits, because a deposit is a liability to the bank. It's money that depositors have as a claim whenever they show up and say, you know what, I need my cash. So in effect, it's shrinking the space for banks to maneuver, and what it means is that the banks have had to be innovative and creative, in order to survive. Now, looking forward, when you talk about what's the outlook, I think the fact is they've proven to be resilient. The last 2 years particularly have shown that Nigerian banks are resilient, and if we look back over the last 2 decades, they've always proven that they're resilient. And so the outlook is that, yes, while we expect that there will be persistent challenges, because we don't see that a lot of the more broader macro issues would disappear overnight. We still have issues with inflation. We still have issues with unemployment. The exchange rate continues to be challenged. Growth is, while it's rebounded strongly in Q2, it remains largely anemic, in that when we look at long-term growth over the last 6 years, we've averaged less than, just about 2%, in terms of GDP. So looking forward, we expect that the banks would continue to be resilient. We expect that there will be growth in loans. We expect that there will be growth in deposits. Where we think there might be a challenge, however, is in terms of income levels. I think on our estimates, we think on average you'll grow about 5.2%, between now and 2022, for example, in terms of PBT. Revenues will be up right about the same sort of mark, compared to double-digit growth on the, asset side.
Now, how well capitalized are the Nigerian banks?
Nigerian banks are actually quite adequately capitalized. If we use, for example, the requirements of Basel III, which requires the banks to hold at least 8% of their total risk-weighted assets in capital, we find that on average, Nigerian banks are holding about 19.7%, capital adequacy ratio, which is quite comparable. In fact, it's much better. It's almost twice the levels, more than twice the levels required by Basel. Although when we then compare Nigerian banks to African peers, for example, Egypt and maybe Ghana, we find that they're just slightly off. I think Egypt is at 21.7%, Ghana is at 20.2%. But those numbers really, what it says is basically the banks have the capacity to absorb losses, if indeed they do arise. That's what the capital
at
buffers
this point,
remain.
should we actually be talking about recapitalization or consolidation?
So a recapitalization may not necessarily be in the works in that sense, unless, of course, we were trying to sort of rebase our capital levels in dollar terms. I think when I think back to the time when the former CBN governor Charles Soludo set up the recapitalization, there were certain benchmarks in mind at the time in terms of dollar levels for what would be licenses for banks to operate. Given where the naira has gone since then, when it was about 120, 130 to the dollar to where it is today, again, depending on what rates you look at, the official at 413 or parallel markets, north of 550. You can see that in dollar terms, the absolute size of Nigeria's bank's balance sheet has shrunk. So from that perspective, there might be a case to perhaps recapitalize. But again, when we look at how much of the bank's earnings have been retained in the form of retained earnings or profits that are held back and reinvested into the business, a good number of the banks are quite adequately capitalized, and I don't think there's a challenge there. What we may find, however, is a consolidation from a strategic standpoint where some banks might choose to undertake some inorganic type transactions, through acquisitions or mergers to further consolidate their areas of strength and position themselves better in the market. So those are the kind of things we might see going forward. Kind of
mergers and acquisition? Okay, thank you very much, Victor. We do appreciate your time on the show. So we look out for better banking sector environment come 2022, I guess.
Thank you very much for having me.
Victor Ndukoba is the Deputy Group MD at Afrinvest West Africa. We'll take a break now. When we come back, we'll look at the politics of subsidy removal and its implications. Do stay with us. The issue of subsidy removal in Nigeria has been a subject of debate over the years. With the continuous dwindling of the federal government's revenue, many economic experts believe petrol subsidy removal is one way to go. At the launch of the World Bank Nigeria Development Update last week, the Minister of Finance, Budget and National Planning, Mrs. Zainab Ahmed, reiterated government's determination to remove subsidy by the second quarter of next year. He also said that in order to ameliorate the immediate effect of the subsidy removal on the most vulnerable Nigerians, a sum of 5,000 naira a month will be made available for these set of people for a period of at least 6 months. This, however, has generated a lot of controversy in different quarters. Okay, let's get the perspective of a policy analyst and strategist and the CEO, Espera Global Corporation, Dr. Glenn Prince Abi. Thank you very much, Dr. Abi, for joining us on the program. Good morning.
Good morning. Thank you for having me.
Well, it's now imminent that removal of subsidy is inevitable. It is also believed that subsidy is approximately at 3 trillion naira a year. That's almost 20% of the budget and 50% of the fiscal deficit. Therefore, what do you think are the implications of removal of subsidy on macroeconomic stability?
Well, thank you for having me on this, and I'm happy to respond to it. First of all, I want us to look at the fact that this question of fuel subsidy removal and all that has been on for a very long time. The subsidy regime didn't start today. It actually started way back in 1970 as a result of global oil boom and things like that, and countries that were into production of exportation of crude oil and all that depended, on removal of subsidy. On subsidizing fuel for their people to ensure that the price of petrol is affordable by their people. You discover that all the way from that time, and even through the regimes of the administration of President Shagari, and then also President Muhammadu Buhari as military president, as well as Babangida and all that, even during General Obasanjo's time as military president and all that, the question of subsidy has been there. It has been like, okay, we have subsidy, but how do we remove it? They decide to observe that it's actually a distorted practice, a situation where you have to sell petroleum products at lower than the cost of its production. Now, one thing with economics is that it is not sentiments. Economics is not sentiments, economics is not politics. Subsidy has been like a kind of a political solution to an economic problem. And once you have a political solution to an economic problem, you create a distortion. And time in and out and all that, you discover that you'll be faced with the same reality over years and over decades. So subsidy has been a practice for so long. And even you remember that as recently as 2012, when President Goodluck Jonathan, after winning his election in 2011, he came up in early 2012 and decided to do a level of removal of the subsidy, reduction of it, and you saw the strike actions and all that. It now dawns on us, it becomes very clear that over the decades, the reality that this is actually an economic practice that is not based on fundamentals. And once you are doing anything that's based on that's not based on fundamentals, it means that over time, the reality of it will hit you harder and harder and harder until you got to deal with it. So first of all, we have to look at it from this perspective. It is a distortion in the economy. You cannot be paying for what you for below the cost of what you're producing, and then paying people just because you don't want them to feel so bad, and then you have to keep the subsidy on. And for your information, subsidy has been a major, the availability or provision of the subsidy for petroleum is actually a major benefit to the big, rich people, power blocks and all that, politicians and top people and so on and so forth. So the question of subsidy removal has been on, and for me, I think I'm even surprised why it has to be removed removed now. If we had dealt with it a little earlier, maybe a couple of years ago, perhaps by now we would have seen the fruition, we have seen the full flowering of the benefits of what we would have gained through the large amounts of dollars that we pay as subsidy. Mark you also is consumption. Yeah.
Yeah.
Yes.
Now, the agitation amongst many Nigerians, over this subsidy removal is the fact that the removal of subsidy will further stoke inflation and further increase the economic hardship and misery, in the society. How can really the government ensure that this doesn't happen?
Now, this is a very smart question, and I'm actually particularly concerned about this subject, and there are strategies for this. There are methods, there are ways to address it. Okay, first of all, let me give you some kind of comparison. In the world today, in Africa, for instance, Nigeria has one of the lowest. I think Nigeria is the lowest in terms of petroleum product, the petroleum product in the marketplace and all that. A number of African countries, including Togo, even after the removal of subsidy, our price of petroleum will not be at the same level as Togo next door is paying for it. So it's unsustainable. Now, what I think should be addressed, okay, let me also remind you of the fact that the country with the lowest petroleum price in terms of massive subsidy intervention is Venezuela. Today, Venezuela's price for fuel is just less than 10 naira per liter. We are on 100 and something per liter and so on, 167 naira per liter and so on. That's Venezuela. And the world knows that Venezuela has an inflation rate that is completely, it's been undergoing hyperinflation for several years, and it has not helped. The fact that the price of petroleum is low, petrol is low, has not helped the economy. Because it is based on a distortion. Now, the more the distortion, the more the impact on the economy. If we look at Hong Kong, for instance, is the location where they have the highest price, pump price, and it's over 1,000 naira per liter. And there's no challenge about inflation over there. So what I see us doing, what I would advise that government should do is look at how the money gained from the subsidy removal should be pumped into the economy in productive sectors of the economy that enhance growth. First of all, the president, in the submission of his budget appropriation, the appropriation bill for 2022 in the month of late September and early October, when he presented that, I did make a comment that the projection for inflation, currently inflation in Nigeria is about 16%, and they have projected a 13% inflation for 2022. And I believe also that inflation can actually come further down. Why? Because statistics show that the major cause of inflation, the major aspect that has made Nigeria's inflation to be that high, both by the World Bank and the IMF, is food inflation. So 70% of the factors for inflation is from food. So if there's an aggressive attack on making food produced, massively produced, it means that we'll be solving 70% of the problem of inflation. Okay, so now with the removal of subsidy, I expect that money is gained, billions of dollars gained, trillions of dollars gained from the subsidy removal should be pumped into agricultural production, should be pumped into the digital economy. I'll come to that later. Will be pumped into areas of renewable energy and all that. So with that, we see that there is what I call a counterpoint, an effective response to what would have actually been a problem. It's actually an advantage. We are rectifying an anomaly that has been there since 1970. And there's no better time to start to do that than now. In fact, better time should have been some years ago. But we can't do it tomorrow. We have to do it now. and they apply the benefits from the subsidy removal, I mean the money that would have gained, into productive sectors of the economy, so that Nigerians have more food on the table, they can do more business and all that, and the inflation will be a very temporary experience, and later you see the economy picking up and things going on like that. Yeah.
Sure, Dr. Abi. Now, the government, of course, deemed it fit to now say, okay, we have to propose to give out 5,000 naira to the most vulnerable, for a period of time. Now, when we look at this amount, this will gulp about 1.2 trillion naira. That's in 6 months. And, of course, this is 3% of money supply and less than 1% of GDP. Well, you already talked about it, channeling the subsidy money, into the system for productive use.
Sectors
but yes, what's your take on this measure that the government deemed fit, to do at this time, the 5,000 naira cash dole out?
Well, I think that it is like a temporary remedy, sort of, a temporary palliative for those that are worst affected by possible rise in prices, particularly in the movement of goods and services and all that. So, okay, that sensitivity that this government seems to have displayed by looking at the very vulnerable in society and all that. Okay, we're removing subsidy. All right, let us look at how would the vulnerable the most vulnerable in the society, how would it be for them? Okay, all right, let's make this available for them. For me, that is just one step. And it's okay, it's welcome, because usually you say, oh, what is 5,000? But cumulative, you're already giving figures, okay? So it's very small, but it's to help them to an extent. But the main strategy, that is a tactic, that is a measure. But the main strategy is actually coalescing and putting together all the gains from the subsidy removal and seeing how it can be pumped into production activities that will help, in particular, first of all, the vulnerable in the society, the most vulnerable in the society, and different parts of the country and all that. And you see that they are able to produce and all that. There are economic frameworks for this. There are productive strategies that can be used. And I said in particular that 70% of the cause of inflation is food. And it's easy to look at the fact that we pump, monies into the agricultural sector and all that, and just discovered that we would have solved a lot of the problems that would have actually arisen as a result of the fact that subsidy was removed. Okay, so it's still, that is one measure. That is just, I will put it a two-pronged fork. One is the immediate, what is given to them, the poorest of the society in terms of the 5,000 naira per person an hour for about 40 million of them. And then the next aspect of the strategy, the most important, I don't even see that as too much of a strategy. The most important, actually, aspect is now looking at various sectors, particularly agriculture and all that, and pumping, funds into it to enable Nigerians have access to food, produce food, and also for eating internally and also for exportation. And other productive sectors of economy, such as manufacturing and all that, and so on and so forth. I think this is an excellent opportunity for that. If it is when that is not done, that we can actually challenge the removal of the subsidy.
Absolutely. Anyway, before I let you go, Dr. Abi, what is your perspective concerning, the way forward for Nigeria in terms of competitive energy policies and programs and the positioning of the economy in a way that's clearly makes Nigeria competitive among other countries?
Yeah, thank you for this question, because the whole question of subsidy is about energy economics. Okay, and I said, when I started, I said something like, it's an economic problem, and then the subsidy itself is kind of a political solution to an economic problem. Now, it's all about energy. The world's economies compete in the global marketplace with one major tool, and that's energy. From the very beginning, I think way back in the late part of the 20th century, early part of the 20th century, and now we're in the 21st century, and you discover that the oil, that is energy, became the tool for competition. And you had all the big oil companies and all that, the Shells, the Mobiles, the Total, Totals and all that, all of them started playing large and became the richest companies in the world. But today you see that the energy sector particularly has having to do with oil, which is a major fixation and which is the cause of this whole subject of subsidizing and all that. You discover that the tool for competition as far as energy is concerned post-COVID and in the way forward for countries is no more oil. So it has to be energy in another dimension. So we should be talking about renewable energy. And if you talk about renewable energy, renewable meaning that, of course, oil, which we're now subsidizing, we're struggling to remove the subject from, is non-renewable. In other words, it has finite availability. Now, when you talk about renewable energy, it is infinite. So what countries are doing, which Nigeria has not even started doing, is looking at how to explore maximally optimize the opportunities that can be extracted from renewable energy such as solar and use the energy derived therefrom to compete in the global marketplace. So the main competitors, the highly competitive countries of the world tomorrow, and that tomorrow is not far, in the next 2 years, 3 years, 4 years, 5 years, 10 years, and all that, will be those that have extracted, that have made the maximum use of renewable energy as their energy tool, as the tool they're using to compete in the global marketplace. And that's what China has achieved. And that's what even the United States is way back on in competition with China. So the whole world now is looking at how we can be better players in terms of energy. So we should get less and less fixated about oil. I am from an oil-producing location. I'm from Calabar University and all that. I don't like talking about oil. I prefer talking about the future. And for Nigeria also, in terms of competitiveness, we should talk about digitalization. You talk about Internet of Things. We should talk about technology. These are the tools that countries are going to compete with in the world, in the emerging world that we're in. Yeah.
Okay, thank you very much, Dr. Abi. Quite insightful there. We do appreciate your time on the program. Thank you.
Thank you very much. Thank you.
All right, let's look at the market and do an opening call there. We have Anita. Anita, the Omicron virus roiled the global market last week. How much did that filter into our local markets?
Good morning, Chimi. Well, surprisingly, the Omicron variant of COVID-19 or the coronavirus didn't have any effect on Nigeria's market, although across the global markets, from Bitcoin to the oil market, and particularly global stock markets. To be precise, all the markets dipped, but Nigeria's stock market was able to make close, the last trading day of last week, up by 0.42%, and that translates to about 104.1 billion naira gained.
Local players more in the market, isn't it?
I don't think we have, but of course, don't forget that we had lots of sell pressure, and that gain that we saw came largely on the back of Airtel Africa. But let me bring you up to speed with all the markets. I'll be talking about 4 markets today. First, starting with the FX market, it was a very strong gain last week. In contrast to the previous week, this is what it came out at: 60.23%. That's the total volume of transactions carried out across the markets that you see there. Now, a breakdown of the results shows you that the total turnover of transactions at the fixed FX spot market was 25.71%. Forwards, 164.67%. So last week was quite impressive for the FX market at the FMDQ exchange. But when you take a look at the Naira was marginally down by 0.03% in contrast to what it was here. So this is what it closed last week as at November the 26th. So, of course, we will be looking at how, we are in the last 2 days of November. Tomorrow will be the last trading day of November, but we're starting off the week first today. So we will see how that market turns out. And, of course, I will be giving you an outlook of what to expect on those markets. Now, let's move over to the fixed income market, where there was selling, there was sell pressure there. There was some, sell-off there, and it was concentrated at the short to mid-end of the curve. In particular, overall benchmark there closed at 8.16%, and that indicates 3.32% decline. Now, over to the Treasury bills market. It started the week very quiet, but ended strong. But in terms of the transaction that we had on Friday, number of deals there was just 3. And then much of the concentration was on the 24th of November, 2022. Moving over to the open market operations, the OMO bills. Well, the yields there increased by 0.36%. And yields on the central bank's special bills, the yields there increased by 18.56%. But as at Friday, just the November 2021 paper had 2 deals there. And of course, it's last day today, so we'll see how. I think that'll be the end for that instrument. Now let's move over to the stock market where I was talking about. We had 54 points. More than 54 billion gained throughout the week. But as at Friday, 104 was what we gained as at that day. But when you take a look at the sectoral performance, not too pretty picture there. Of course, that's not related to COVID. This was as a result of profit taking, of course, which dented the performance across 4 other counters, except the insurance subsector, which had 3.56% there. Now, in terms of the overall activity there, it was quite increased. We had a 146.72% increase in contrast to the previous week. So this is what it turned out at the close of the 3rd trading week of November. Now, at the unlisted securities market, it was down by 0.16%. But I won't dwell much on that market because it's still a small market. But what we'll be having, we will be expecting this week about 54.3 billion naira inflows from open market operations at OMO maturities, as well as 5.63 billion naira FGN bond coupon payments, which is expected to hit the financial markets this week. Then, of course, the yields across the Treasury bills and the bond market, as well as the equities market. We'll be looking at how they all end the last trading day of the last 2 days of November. So eyes out for that.
Thank you, Anita. Well, I wouldn't say that any market is small as long as you earn something from it. Okay, thanks. All right, we'll take another break. And when we come back, we do a crossover to London. Just stay with us. All right, it's Monday morning. Let's see what's happening out there in London. We have Juliana. Good morning, Juliana. Good to see you. Well, countries, including the UK, have slammed travel ban on southern African countries over the Omicron variant. Now, this remains a developing story. It's a new week. What are you hearing about these travel bans, particularly from the UK authorities?
Yeah, good morning, Chimezie. It is a developing story, a major story. Of course, COVID, with the variants that it has already infected over 261 million people. Over 5 million people have lost their lives. Now, the World Health Organization have designated this new Omicron variant as a variant of concern, which is why we've seen over the past couple of days lots of new travel restrictions and border closures being imposed across the world. Here in the UK, on Saturday evening, Prime Minister Boris Johnson, alongside the Chief Medical Officer and the Chief Scientific Advisor, gave an update to UK citizens. We've got new measures in place to try and curb the spread of this new variant. There are believed to be about 225 cases in the UK. I believe just a couple of moments ago, Scotland confirmed that they've got 6 cases of Omicron. So from today, face masks are mandatory in public places and on public transport. There is going to be another update later this afternoon by Sajid Javid, the Health Secretary. If you are flying into the UK now, you will need to take a PCR test and you must self-isolate until you have the result. Now, this PCR test will be taken on day 2, so this has caused complete havoc to travel plans for individuals. So even if you do have 2 vaccinations, when you travel back into the UK, you must self-isolate for at least 2 days. That's caused lots of stir. There are lots of voices that are saying the government haven't gone far enough. They want border closures. But, Chimeze, I don't know if you remember this time last year, you know, this was almost the same issue we had with the Kent variant, now called the Delta variant, where just in the run-up to Christmas, everything was shut down, I believe, literally days before. What the headlines are saying in the UK is we have 2 weeks to save Christmas so that we can celebrate with our loved ones. But of course, this is a major concern, not just for Britain, but for countries across the world.
Absolutely. Anyway, the fear of this Omicron virus, we saw that roil in the global market on Friday. How are the markets where you are now recovering from the weekend bloodbath? And what is the outlook for this week?
Yeah, well, there has been a recovery of some sorts. As you said, the markets were terrible on Thursday and Friday. We didn't see the FTSE fallen this much this year, fell by about 4%. But there does appear to be some hope. It does appear as if at this present moment, investors seem to have shrugged off some of the fear and anxiety they're having about this variant. One of the big risers is BT, the BT Group, a huge Indian telecom firm, seems to have tapped into whether or not they'll be buying out BT, which is pretty interesting. They are up 9% this week. But as I was saying, you know, there's still so much coming out of this Omicron variant, lots of noises, and the drum beats of lockdowns are coming up. So it'll be interesting to see just how travel and leisure stocks will fare over the next couple of days. But at the moment, the FTSE is trading in positive territory.
All right, thank you very much. And I'm sure you have more update for us on those measures to curb the Omicron virus later on Business Incorporated. All right, let's talk crypto now. Well, Ladi, talking about our crypto market, but sometimes I just wonder when you can ever, you know, talk about our own e-Naira on this platform.
Well, of course, we'll be talking about the e-Naira because the e-Naira actually is getting a lot of downloads. You know, when you check the Play Store, you know, we see e-Naira is getting some traction.
Have I told you? I already have it. I have some money. I have some money in it.
Okay.
300 Naira, you can't believe
300 Naira. Okay, what will happen is...
And it's quite easy. It's quite easy, really. You know, it's quite easy to download. It's quite easy to operate. And then, I mean, if you already have it, I can actually, you know, transfer money
we can
you,
do a test,
you know.
Yeah, you send me some money, we'll see how fast it gets into my wallet.
Yeah,
and maybe
absolutely.
I don't return it.
Very fast.
Yeah.
Very, for now anyway, for now. But, I mean, it depends on how well people are able to get on board and get used to it.
It's going to take time to get used to it, for sure.
Particularly businesses, you know, being able to even pay, you know, with this, you know, through this channel. That's just the thing there.
It's quite interesting. We'll keep tracking, you know, the progress of the e-Naira and the wallet. But the crypto market, it was a bloodbath on Friday, though. So we're beginning to see a bit of recovery. Bitcoin back to 57K. Quite a big bounce there. And major altcoins and Ethereum back in the green on Monday from that huge sell-off that we had on Friday due to the Omicron Delta variant there. Now we see a market cap, $2.57 trillion, is up 5.51%. Quite a good recovery in the total crypto market. $107.95 billion traded in the crypto market, up 2.60%. Bitcoin dominance, 42.13%. See Bitcoin dominance inching up there. And back to the price of Bitcoin, $57,463. On Friday did fall about 10%, with Ethereum also down 10%. That's the major fall it's had in a while this year. It's up 5.72% this morning from a 54,000 low. 24-hour volume, $29.31 billion traded in Bitcoin this morning. See Ethereum there still sitting pretty above the 4K range, $4,330. Volume traded in Ethereum, $17.56 billion traded this morning. Quite impressive comeback we see there. Looking at the top horse by market cap, we see it's all green there with Solana there being the biggest gainer there, up 8.15%, $204. It did fall below the $200 mark. If XRP still below $1, but it's had a recovery there, it's up 7%. So we might see XRP within the week above $1 again. Price of BNB there, we see it's a backup above $600, up 4%. Cardano, even though it's quite a laggard this season, it's up 6.48%. Let's bring in Olumide Additional now. Hello, Olumide. Good morning.
Yeah, hello, Laji. Good morning.
Yeah, Olumide. We thought it was all over on Friday with that massive sell-off. See, Bitcoin, Ethereum, and a couple of altcoins, all double digits down Friday. It was quite scary. And, considering the crypto market doesn't close, the weekend was, we also saw a sell-off, but now we have this bounce. What's happening?
Yeah, it's just for listeners, what really happened on Friday was that the Omicron mutant strain of COVID-19 really created an alarm in financial markets. We saw almost all assets going red except for gold. And that really, the panic was so bad that Bitcoin lost almost 10% for that day. And it escalated over the weekend, but recent reports from Moderna, a leading vaccine maker, suggest that they can really treat that mutant strain. So they're expecting that dosage applications will be ready early next year. So that really calmed investors. And we saw everything coming up green this morning. But albeit we suggest that the fact that the US dollar is also gaining ground suggests that it will be very difficult for Bitcoin to break above the $60,000 mark. And that's why we see the fact that Bitcoin is presently hovering below the technical level of 58,000.
All right, Olumide. So this week we can expect, to see some positive price movement, I'm guessing.
Yes, we expect to see some positivity, but okay. I think the investors need to be cautious. One thing remains very clear. Bitcoin is not hitting $100,000 this year because the drive around COVID-19 has disrupted the crypto market.
All right, Olumide, thank you so much. Always good to talk to you.
Thanks, Daddy.
All right, Chimi, see with top 5 gainers there, we see the Metaverse tokens back up 25% there with Sand, $7.58. They are supposed to launch the play-to-earn game today, so we'll see how the price action continues with that. And Chimi, after the show, we send your 300 Naira to my wallet to see how it works.
I'll try that. But I mean, I can see there's still a lot of uncertainty in the air, concerning this particular market. So
oh, yes.
I think
quite a risky market.
I think the word still remains caution.
Caution.
Absolutely.
Caution.
All right. Thank you, Ladi.
All right.
Okay. That's a wrap on the program for today. And don't forget to join us by 1:30 this afternoon for Business Incorporated for more updates on developments in the world of business. I'm Chimezie Obi.